Okay, so this next video lecture is about the tools that we will use for capital investment decisions. So here we have the non-discounting and discounting methods. Okay, but for this video, we will only be discussing about the non-discounting method, which is the first technique is the payback period. Okay, so here, um, as mentioned, so the models used for making capital investment decisions fall into two major categories. So as I have mentioned earlier, so we have the non-discounting models and the discounting models. Okay, so for the non-discounting model, so here, the feature of this is it ignores the time value of money. Okay, whereas discounting models explicitly considers it. Okay, so time value of money concept is where if you are an investor, you would prefer to receive the money now, okay, than receiving it in the future, because the money that you will receive now has a potential investment earnings, okay, if you will put that into a particular project or investment. Okay, because as the time passes by, the value of money decreases because of the effect of inflation. Okay, so the effect of inflation is uh, the value of money decreases, or the purchasing power of peso, in our case here in the Philippines, decreases. Okay, so mean to say, for example, in 2010, if your 500 pesos is able to purchase 10 items of goods, okay, in 2020, if you will compare your 500 pesos during 2020, so probably you can buy only 5 items, okay, for your 500 pesos. Okay, so if you could notice, the purchasing power of peso decreased. Okay, that is the effect of the time value of money. Okay, and as well as the inflation. Okay, so here, talking about time value of money, so we will consider some interest factors. Later on, you will know that, or you will learn that as we discuss the discounting model. Okay, so again, under this video, we will only be discussing the non-discounting model first. Okay, so although many accounting theories they discourage the non-discounting model, okay, because it ignores the time value of money, which is considered to be very important, especially in making and deciding for investment decisions. Okay, so many firms continue to use them, however, okay, in making capital investment decisions. So depending on the decision or the choice of the management, whether they would accept it or they would rather prefer to use the discounting models. Okay, so we go to our payback period. So here, when we say payback period, so this is considered to be one type of a non-discounting model. Okay, so the payback period is the time required for a firm to recover its original investment. Or in other terms, when we say payback period, this is the number of years, okay, that you can recover the amount of money that you have invested. Okay, so for example, if you have invested 100,000, so how many years would you recover that investment? Okay, this is what we call payback period. So to continue, um, when the cash flows of a project are assumed to be even. Okay, so when we say cash flow, okay, by the way, cash flow is the financial benefit that the investor receives every year, okay, out of investing, okay, for a particular project or proposal. Okay, so for example, if the cash flow is even, meaning to say every year for 5 years, the investor receives a benefit or return of 5,000. So meaning to say, for the first year, he receives 5,000. Second year, 5,000. Third year, 5,000. Fourth year, 5,000. And fifth year also is 5,000. Okay? For as a return out of his or her investment. Okay, this is what we call even cash flows. So here, the formula can be used to compute, okay, for the payback period. So again, if the cash flows is even or uniform, this is the formula that we will use to compute for the payback period. So this is the original investment divided by the annual cash flow. Okay, so this is how simple payback period is computed. So we have here the general rule. Okay, please take note. We will only accept the investment if its payback period is shorter. So meaning to say, okay, for example, if you are required to invest 100,000 for 5 years investment period, okay, and based on our computation, the payback period is 4 years. So meaning to say, we will accept the investment because its payback period is shorter than the life of your investment. Okay? So in an opposite manner, we will reject the proposal or the investment if it will take you too long, okay, to recover the investment. So you're seeing our example, if the investment period is 5 years and your payback period is 6 years. So meaning to say, your payback period is longer. Okay, so we will reject the proposal. Okay, so again, this is if um, the case is your cash flows is uniform or even. Okay, what about if your cash flows is uneven? Okay, so however, if the cash flows are uneven, our payback period is computed by, so this is how you're going to compute your payback period. We will simply add the annual cash flow until such time as the original investment is being recovered. So in this case, for example, the investment period is 3 years. For the first year, the investor receives 10,000. For the second year, the investor receives 20,000. And for the third year, the investor receives 30,000 return. So this is what we call uneven cash flows. Okay, so here, what you're going to do is to just add all of the cash flows until such time that we will reach the point or the year where that cash flow is equal to your investment or initial investment. Okay, so our general rule is still the same. We will only accept the proposal or investment if the payback period is shorter. Okay, and we will reject it if it will take too long, okay, for us to recover the investment. So the same general rule. Okay, however, in terms of uh, computation or formula, we have a different way, okay, of determining the payback period if your cash flow is, or it depends, I mean, if the cash flow is even or uneven. Okay, so here, for example, we have here an example. Okay, so In our example here, suppose that a company is considering two different and mutually exclusive projects. Okay, so again, if you could still remember in our previous video lecture, we mentioned about the independent projects and mutually exclusive projects. So in this case, we have the mutually exclusive project, meaning to say we will only be accepting one project. If you will accept project A, we will reject project B and vice versa. Okay, so here, they both have a 5-year investment life, and it requires the organization or the investor to uh, give or provide $210,000. Okay, so the cash flow patterns for each projects are given. So these are our this is our data for the two projects. So for project A, so it requires uh or it I mean provides cash flow, even cash flow of 70,000 every year. While for project B, okay, we have the following. For the first year, our cash flow is uneven, by the way. Okay, for under project B. So for the first year, we have $120,000. For the second year, $100,000. Third year, $90,000. Fourth year, $50,000. And for the fifth year, it's $30,000. Okay, so here, of course, the requirement is for us to determine which of these two projects will provide us with a shorter payback period, so that we will determine, okay, if what project will be accepted or rejected. Okay, so to compute for their payback period. So for the first project, for project A, so this is even cash flow. Okay, so we will use the formula that is provided earlier. Okay, so this is the original investment divided by the annual cash flow. Okay, so following the formula, okay, so our original investment is $210,000. Okay, so we will just divide it by the even annual cash flow of $70,000. So therefore, here the payback period is 3 years for project A. Okay, so if you could still remember, if you will compare this with the life of the investment, okay, it's 5 years. Okay, whereas based on our computation for project A, the payback period, or we can or the investor can recover their original investment in 3 years. Okay, so basically, if we will look into uh, the solution, okay, so project A is acceptable, okay, because it has a shorter payback period compared to the life of the investment of 5 years. Okay, what about for project uh project B? Okay, so for project B, we have here the computation. So if you could still remember, we will just add all of the cash flows. Okay, because we have, or in this case, the project B is uneven cash flow. Okay, so we will just add annual cash flow. Okay, until such time that we will determine, okay, if that is now equal to the original investment. So this is how you're going to do this. So first, you could see the table. We have here the column for the year, the column for the unrecovered investment, beginning of the year. Meaning to say how much is the investment still that is not recovered, okay, as of the date or of the year. Okay, and then for the third column, we have for the annual cash flow received, okay, by the investor. So this is provided in our problem earlier. Okay, and then this is the time needed for payback in terms of number of years. Okay, for example, in year 1, okay, so for the first year, at the beginning of the year, the unrecovered investment is still $210,000. Okay, so mean to say, there is no cash inflows yet. So, however, after or at the end of the year, okay, based on the data, the investor was able to receive $120,000. Okay, so what you're going to do is to deduct this annual cash flow received to that of the unrecovered investment. Okay, so therefore, okay, 210 minus $120,000 for the second year, the unrecovered investment now is only 90,000. Okay, so this will be expected to be recovered in the next years. Okay, so after that, for the time needed for payback period, so here we will place or write there, okay, 1 year. Mean to say after 1 year, the original investment is not yet recovered. Okay, so we will proceed with the second year. So as mentioned earlier, the unrecovered balance is still 90,000. So for or at the end of the second year, the investor now receives 100,000. So if we will compare the annual cash inflow received with that of the unrecovered investment, this is larger or amount. So mean to say, this 90,000 can now be covered for this year. Okay, however, how many, to be exact, how many months is that during the year, okay, in which the investor actually recovered in full the 90,000? Okay, so here what you're going to do is to divide the unrecovered balance of 90,000 by, okay, the annual cash flow received during the year. So this is how you will determine, okay, the number of months, okay, basically, okay, for on when does the 90,000 was actually recovered, to be exact. Okay, so we get the ratio. Okay, so that's 0.9 year. Okay, so here, we will just, to get or to determine the payback period, all you have to do is to add, okay, the time needed for payback. So therefore, based on our computation, the payback period of project B is 1.9 years. So again, if we will compare this with the investment life of 5 years, project B is also acceptable because it has a shorter payback period. Okay, so however, in our case, what we are looking for is the better investment between project A and project B. Okay, so therefore, based on our computation, so between these two projects, the management should accept project B because between these two, it has the shortest or shorter payback period. Okay, 1.9. So please take note that we have or we are required, okay, for the same amount of investment. Okay, so this is how you make in capital investment using the undiscounted method under payback period.